Welcome back to Lessons from the Fall. There's a principle in business that I come back to again and again. If you want to understand what's going on or what's going to happen, don't look at what people are saying, look at the incentives. Because incentives drives behaviour every time. And right now, in Australia, we're looking at a potential shift in incentives through tax, through policy, through how capital gains and super are treated. Now, on the surface, these changes are being positioned as fairness, addressing inequality, rebalancing the system. And those are very valid conversations. But underneath that, there's something much bigger happening. Behaviour is about to change. Let's start with capital gains tax, because this is where it gets interesting. There's discussions around changes that could significantly increase the effective tax paid on long-term investments. In some cases, estimates suggest increases of around 40%, depending on income levels and holding periods. Now, think about that for a second. If the reward for holding an asset long-term decreases, what happens? People don't just accept that, they adjust. They start asking, is this still worth holding on to? Should I be investing differently? Is there a better structure? And this is where things start to shift. Because if capital gains becomes less attractive, yields become more attractive. Dividends, cash flow, defensive assets. And that doesn't just affect investors, it affects companies. Because if investors start demanding yield, boards respond. Less reinvestment, more distributions, which potentially slows growth. Now think about that at a broader level. You're not just changing tax, you're changing how capital is allocated across the economy. And that's the most important part people miss. Now layer in something else, superannuation changes. From July 1st, we're moving to a system where super is paid at the same time as salary. And on the surface, that improves transparency. It helps people track what they're owed. It reduces underpayment. But what's interesting is the unintended outcomes. Higher income earners, especially those with bonuses or commissions, could actually benefit more than expected. Through timing changes, through how contributions are calculated, in some cases even receiving significantly higher super contributions than before. Now, again, same principle. Change the structure, change the outcome. And this is why I keep coming back to incentives. Because when you adjust the system, people don't stay still. Investors restructure, businesses adapt, capital moves. And we're already seeing that. More investors looking at alternative structures. Companies trust super vehicles. Trying to find efficiencies, trying to manage tax, trying to protect returns. Because at the end of the day, capital is rational. It doesn't move based on emotion. It moves based on outcome. And here's another layer to this. Women in business. We're seeing a significant rise in female entrepreneurs building wealth independently, and that's freaking amazing. Almost 40% of Australia's richest women are now self-made or have built wealth through business, not inheritance. And sectors like AI, retail, and tech are accelerating that shift. Now think about how policy interacts with that. If you change how capital is taxed, if you change incentives for growth versus yield, that impacts who builds, how they build, and where capital flows. Because entrepreneurship relies on reward. If the reward changes, if the reward structure changes, so does the behaviour. And this is where things become very real, because these changes aren't theoretical. They don't sit in policy documents. They show up in decisions. Should I invest here or somewhere else? Should I grow this business or extract income? Should I hold this asset or move capital? And those decisions collectively shape the market. Now, from where I sit, Working in lending, structuring deals, speaking with investors, there's a clear shift happening. More questions, more awareness, more focus on structure. Because the environment is becoming more complex. And the complexity doesn't remove opportunity. It just changes who understands it. So the real takeaway from all of this is simple. Don't just look at policy, look at the incentives behind it. Because once you understand the incentives, you understand what's happening next. And right now, we're at the beginning of a shift, not just in tax, but in behaviour. This is lessons from the fall, and sometimes the biggest changes don't come from what's announced. They come from how people respond to it.